It's been over 1 year since I last talked about Singapore dividend stocks. So in this video, I'll be updating my list for the top 5 Singapore dividend stocks for 2023. Full disclosure, I currently do not own any of the dividend stocks that are mentioned here. And the reason is because I currently do not need dividend passive income yet. But when I do, these are the stocks that I will be getting. With that being said, let's start right now. Okay, before I share the list, let me first share how I find good dividend stocks. Unlike growth stocks, where you need to check a ton of stuff, like whether the revenue is increasing or not, does it have a low debt, strong moat, strong cash flow, all these kinds of complicated financial stuff. Dividend stocks, on the other hand, are a lot easier to choose because there are 3 main criteria that tell most of the story. First, the stock must go up over time. This is quite obvious, right? Over the long term, the stock will always reflect the true value of the company. Stock up, company good. Stock flat or down, company bad. Second, the dividend yield must be normal. Dividend yield is just the dividend divided by the stock price. Dividend yield must not be too high and must not be too low. For Singapore dividend stocks, a normal dividend yield would be around 3 to 6%. Here's why. If the dividend yield is too low, like 1 to 2%, then it's not worth looking at because we can easily earn 3 to 4% from T-bills and SSB right now. On the other hand, if the dividend yield is too high, like 7% or more, it could mean that something is wrong with the company because there's no way the dividend yield can remain high. If it was such a good company, everyone would be rushing to invest in it, causing the stock price to go up and dividend yield to go down. The only reason dividend yield can be so high is because investors are selling the stock, which causes the price to go down and dividend yield to go up. For example, Lipo Malls has like 12% yield. The stock looks bad. First REIT has a 10% yield. The stock looks bad also. In short, try to look for a dividend stock that's around a yield of 3 to 6%. Third, the dividend must go up over time. This is quite straightforward, right? The whole reason you're investing in a dividend stock is because you want to receive a dividend. But if the dividend stays the same forever, then it means that the company isn't growing well. Then it will be a bad dividend stock to invest in. So with these 3 criteria in mind, let's go to our first dividend stock, Frasers Centrepoint Trust. If you live in Singapore, I'm sure you have been to at least one of their malls, unless you are an otaku and never leave the house. This REIT owns 9 retail malls in Singapore, in the north, east and south. I guess they don't care about the people living in the west. Just kidding guys. All of their malls are located next to MRT stations, which means that they will get a lot of shopper traffic. Their retail portfolio is well diversified, with no single property accounting for more than 19% of net lettable area. And a big part of their tenants focuses on essential services like F&B, services and supermarkets. As for the debt profile, the gearing ratio is quite low at 33%, which means that they can take on a lot more debts if needed to. They have an average interest rate at 2.5%, which is considered low, and 71% of the debt is fixed. Though, if you look at the debt maturity profile, you will see that starting from 2023 to 2025, a big part of their loans are going to mature, which would mean that they are going to refinance their loans at the higher interest rates. Now, let's look at how well Frasers Centrepoint fits the 3 criteria that I mentioned just now. The stock has grown by over 46% over the past 10 years, which is actually not too bad, given that it's a stable dividend stock. It has a healthy dividend yield of 4.86%. As for dividend growth, it has a compounded annual growth rate of about 4% a year. There was a sharp drop in 2020 because, malls weren't doing so well due to all the COVID lockdowns. But they have mostly recovered by now. The reason I like this REIT is because all their malls are located at very strategic locations. And people will always want to visit the malls to do their shopping, to eat and to watch movies. Because of this, the REIT will always do well unless another pandemic happens, of course. Quick pause. New year, new me. Webull has recently added 2 new features. The first feature is index options trading. So you can now trade options on your favorite index funds. The second feature is mutual funds trading, which means that now you can buy mutual funds and park your idle funds into low-risk funds to earn a yield. In their latest promo, Webull is giving out $150 cash voucher. To get it, all you need to do is deposit 2,000 SGD, buy 1 US stock or an ETF with a minimum transaction of $100, subscribe to 1 mutual fund, and buy 1 US option, all while maintaining a $2,000 net account value for 30 days, and you will receive $150 cash voucher reward. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Moving on, Mapletree Logistics Trust. This REIT has always been my personal favorite. As the name suggests, this REIT focuses on logistic buildings. Their properties are well diversified across Asia, with the top 2 countries being China and Hong Kong. Their tenants all come from different sectors, like there's F&B, fashion apparel, cosmetics, consumer staples, and so on. If we look at their debts, their gearing ratio is at 37%, which is quite healthy. 82% of their debts are fixed, so that's good, especially in this rising interest rate environment. Their debt maturities are well spread out, with the most maturing in 2026, which hopefully by then, all the high interest rate would have come down already. The stock has gone up almost 80% over the past 10 years, so that's quite good. Dividend yield is also quite high at 5.13%. The dividend has been steadily growing at a compounded annual growth rate of 4.2% a year. And the best part, dividend didn't drop at all during the pandemic period, which shows how resilient this REIT is. Personally, the reason I like this REIT is because of how resilient it is. The management is always hard at work acquiring new assets, redeveloping existing assets, and divesting old ones. And by doing so, this REIT will keep growing steady from PP. Next, Mapletree Pan-Asia Commercial Trust. This REIT is basically 2 REITs, Mapletree Commercial Trust and Mapletree North Asia Commercial Trust combining into one. By merging, they will have more money to do stuff like undertake capital recycling opportunities, do asset enhancement, and pursue larger acquisitions. This REIT owns 18 commercial properties across 5 countries in Asia. Their 3 biggest performing assets are Mapletree Business City, VivoCity, and Festival Walk Shopping Centre in Hong Kong. Their biggest tenant is Google, which contributes to 5.8% gross retail income, followed by BMW and Seiko. And again, their tenant sectors are well diversified. You have IT, F&B, banking, fashion, and so on. Rental rates have gone up for most properties, with the exception of Festival Walk, where rental rates have dropped by negative 11.5%. Though things are certainly improving now, as 1 year ago, rental reversions were much lower at negative 24%. Let's look at the debt profile next. 40.1% gearing ratio, which is a little high compared to the rest of the rates that I've shown just now. 72.5% fixed rate debt, and most of the debt will be maturing around 2024 to 2027, which hopefully by then, interest rates would have already come down. Alright, let's analyze how well this REIT fits the 3 criteria. Stock has gone up almost 90% over the past 10 years, dividend yield is quite high at 5%, and the dividend has a compounded annual growth rate of 5% a year. Though in recent years, dividends have dropped a little due to pandemic lockdowns. But going forward, analysts are expecting things to go back to normal. In summary, even before the merger, Mapletree Commercial Trust has been a really solid REIT. After the merger, they will have more capabilities to continue expanding and provide more value to their investors. Next, Mapletree Industrial Trust. This REIT focuses on investing in industrial buildings and data centers located in North America and Singapore. Their tenants come from different sectors, and no trade sector accounts for more than 17% of the portfolio's gross rental income. If you look at the debts, Their gearing ratio is at 37.8%, which is quite healthy. 74.2% of their debts are fixed debt, so that's good. Most of their debts are expiring around 2025 to 2028, which hopefully by then, they will be able to refinance at lower rates. Alright, for this REIT, the stock has gone up over 100% over the last 10 years. Dividend yield is at 5% with the dividend compounded annual growth rate of 5% a year. Like all the other Mapletree REITs, this is another really solid REIT. Similarly, the management is always busy acquiring new assets and upgrading existing ones, which will all improve their revenue. Moving on, the last dividend stock is not a REIT, but a bank, and it is DBS. Okay, I'm not saying all the other banks are bad, yeah. UOB and OCBC are good banks, but personally, I prefer DBS as they are able to deliver the highest return on equity compared to the other two banks. In this high interest rate environment, DBS and all the other banks have been performing quite well. For example, DBS net profit jumped 23% per quarter from the previous quarter, supported by a rise in net interest margin. Basically, net interest margin is an important measure of a bank's profitability. It's the difference between interest that they pay you and the interest that they receive from borrowers. DBS has a low non-performing loan ratio of 1.2%, which means that there's only a small percentage of people who are not able to repay the loan. This year, DBS has expanded by acquiring City's retail business in Taiwan. For this bank, the stock has gone up over 150% over the last 10 years. Dividend yield is at 4.25%. And unlike the previous REITs, DBS dividend growth is a little cyclical. Sometimes it goes up, sometimes it goes down. But nevertheless, the compounded annual growth rate is quite high at 9.9% a year. Now, one thing to take note of is, even though high interest rate environment is good for banks, there's a risk that if the rates become too high, there might be an economic slowdown. Loan growth may decline and customers may even default on their loans, all of which will affect DBS profitability. So, those were some of my favorite dividend stocks. But do comment down below and let me know, what other good dividend stocks do you know of? Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.